Brad Williams, Frugal Finance, Unit Investment Trusts. These are old school tools, but perhaps they've been reworked in this new era and they may be worth a second look. Why unit investment trusts deserve a closer look. Unit investment trusts, UITs, don't get the spotlight like mutual funds or ETFs, but their simplicity and structure offer something surprisingly powerful. Clarity. When you invest in a UIT, you're buying into a fixed basket of securities that doesn't change unless something like a merger or bankruptcy forces a move. There's a start date, a set portfolio, and a clear end. That rigidity might sound limiting, but it's actually liberating. No surprises, no hidden rebalancing acts, and a timeline you can plan around. For investors tired of constant churn, that discipline can be refreshing. Anatomy of a unit investment trust. A unit investment trust pools funds from investors, then uses that capital to purchase a carefully chosen portfolio, usually stocks or bonds. Instead of ongoing trading, UITs launch with a one-time offering of units, which investors buy like shares. Each unit grants proportional ownership in the full trust. Once established, this trust doesn't actively manage its contents. You'll typically get income, gains, and the return of your investment distributed over time or upon maturity. The maturity mistake most people mistake. Here's where investors get tripped up. They don't plan for the end. Every UIT comes with a defined termination date, but not everyone reads the fine prints. Maybe it's in 24 months, maybe it's 24 years. Without clarity on that timeline, you could find yourself locked into an illiquid position or selling too early at a loss. Even worse, some roll their proceeds into new UITs without realizing they're paying fresh sales charges every time. Those costs could add up quickly. What happens over time? From day one to maturity, a UIT stays the course. That means no reallocation, no style drift, just passive holdings of its original selections. The trust periodically pays out income, and when it ends, you receive what remains. Over time, this setup can smooth volatility and reduce knee-jerk reactions to market swings, but it's not without risks. Poor performing assets stayed put. So, the timeline offers discipline, but not protection. Understanding this is key to making a UIT part of your long-term plan. A mental model for evaluating UITs. Think of UITs like a time capsule. You choose the content, seal it, and agree not to open it until a set date. That model helps investors stick to a theme or strategy, income, growth, or sector-specific bets without getting swayed by market noise. But what's inside matters. The risk of each holding remains throughout, so your performance depends entirely on your original choices. Discipline is powerful, but only if the ingredients are good. Real-world use cases. UITs often appeal to retirees who need predictable income or to new investors looking for a passive way to commit to a strategy. They're also useful when you want exposure to a theme, like dividend payers or municipal bonds, without building it piece by piece. But transparency is key. Always read the prospectus, know the fees, and understand how your units can be redeemed if needed. A UIT won't adapt for you, so you've got to plan with precision. Putting the system together. To see the full system, start with structure. One-time issue, fixed holdings, clear maturity. Add in considerations like income payment, taxation, and exit strategy. Now, layer risk, credit quality, interest rate shifts, market volatility. Visualize it like a pyramid. Foundational structure, layered by planning, topped with precision in execution. UITs are a system, not a guess. And like all good systems, they work best when understood fully from start to finish. Investing with intention. UITs aren't for everyone. They're not flashy or flexible, and they won't adapt midstream. But for investors seeking clarity, discipline, and a defined goal, they offer rare transparency in a noisy market. Understand the structure, know the risks, and commit to the timeline. Do that, and you can use UITs not just to invest, but to make strategic decisions with calm intentions. I was a stockbroker long ago. I hated UITs. I still hate UITs. There are so many better investment strategies out there. The cost of UITs is just egregious. It's greed, 8 to 10%. Maybe that's lower today, but no, I'm not a fan of these, but perhaps you are. And if so, tell me why. For those who don't understand UITs, then focus on something that rings a bell for you, something that works for you that you fully understand. UITs, if it works for you, good. If not, find another investment. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.